right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, and I'm excited to be bringing this message to you. If this is your first time listening in, I appreciate you being here. Chances are you got this sent to you from a friend or found us through the algorithm, whether it's on YouTube or Spotify or Apple Podcasts. If you get any sort of value, we do request that you leave us a 5-star rating and review. That helps us get in front of the eyes and ears of listeners and viewers just like yourself. If you haven't yet checked out our YouTube page, go ahead and give us a subscribe there. We are really looking to promote our video content and posting it regularly. We have a very strong video editor and content creating team who we value deeply, and we want to recognize their work by getting more people to view it. So with all that in mind, today we're going to be talking about a topic that is very near and dear to a lot of our listeners and a lot of our audiences. We get a handful of questions every week. We're talking to a lot of people every week, and we know that there are some questions that come up more often than others, and the one that we'll be addressing today is one of those, and it has to do with the topic of syndications. And syndications, for those who are new to the real estate world or still getting their feet wet, they are a group-funded investment project. They usually go after bigger commercial projects with more units than you might find in a duplex or quadplex. I mean, they can range from anywhere from a 16 unit, which might be a little less of a syndication and more of a partnership, and go all the way up to, I mean, we've seen them 400, 500, we've seen 1,000 units on some of our properties. And they are a way to kind of find that strength in numbers, right? Because you can pool a lot of money together and go after these bigger fish rather than just taking whatever money you have and going after the smaller fish or that in the smaller pond of the single family or duplex or quadplex industry. So with syndication comes a lot of questions, right? Taxes or real estate in general obviously brings up the topic of taxes regardless of what industry or investment you're going after. A lot of the questions remain the same, is like, how can I save on taxes if I'm investing in warehouses, if I'm investing in short-term rentals, if I'm investing in syndication? What tactics do you have that will help me as somebody who's investing in a syndication save on taxes? And we're going to be covering that, as well as a lot more that needs to be covered in the topic of taxes when it comes to syndications. And let me preface it all by saying this serves as just a general overview of the syndication tax topic. And if you have specific questions to your specific profile or your specific situation, we can't recommend you enough to find a tax advisor who you mesh well with and know will get the right answers to you. This allows you to be equipped with some information, but by no means does it serve as what should be your only tax advice. We recommend that all of our listeners get tax advice that they find to be useful and beneficial for their specific situation, because no situation is the same, but we can provide you with general overview and things that you should be aware of as somebody who might be involved in syndication. So tax topics that have to do with syndication, specifically what can people do in syndications to decrease their tax burden, or what tax benefits come with investing in syndications. Because if you go to Google or social media, you'll find a wide variety of tax insights, tax benefits, tax drawbacks when it comes to investing in syndication. So our goal here is to give you a concise rundown of things that you should be aware of, some things that you might be able to take advantage of, some things that you might miss out on by investing in syndication. So first things first, one of the things that you must be aware of is depreciation. And when I say you should be aware of, you should make sure that these people who are operating the syndications are aware of these things, that they are working with a real estate tax professional that is going to make use of things like depreciation, right? Because there's no sense in buying a property and not depreciating it, when we all know that depreciation is one of the chief benefits of investing in real estate. Because as your property appreciates, because they're not making any more real estate or any more land where the real estate is being placed on, that increases the value, right? Supply remains the same, demand goes up, and your value is going to increase over time. So the property itself is appreciating, but according to the tax code, it is also depreciating. Capital assets depreciate over time. Think of the old adage that when you buy a car, it decreases in value the second you drive it off the lot. The idea of depreciation holds true in real estate. When you buy a property, it is said that it decreases in value according to the tax code, and you get a write-off for that. However, we know that real estate appreciates over time, right? They always say, when is the best time to buy real estate? It was 20 years ago because values were much less than what they are now. When is the second best time? It is right now, because values are as low as they will be in the future. And so one of the things that you need to be aware of as syndicators or people thinking about syndication is this idea of depreciation. Now, does depreciation work for everyone? Yes and no, right? The classic answer to a lot of people's questions is it depends, right? Whether you're going to the doctor, does dairy work well for my diet? It depends, right? It depends on a lot of things. Does depreciation work for my profile? It depends. It depends on a lot of things, right? One of the things is, what do you do outside of the syndication? What is your full-time job? Are you in real estate full-time? Who are you working with? How many hours are they putting in? And all that comes into play when we consider what the max amount of benefit is from depreciation. But the idea remains the same, is that depreciation is something that you should be aware of. It is something that should be applied at the syndication level and at the individual property level, because without depreciation, you're going to be paying more taxes on that property and the income that it is generating, regardless of who you are, right? The difference lies as to whether you can deduct some of the losses that might come as a result of depreciation, but the benefit still gets there, is that if you show a loss of 1,000 or you show a loss of 0, you still made use of depreciation because you decrease the actual income, right? Your property is likely generating cash flow and you're still able to show a paper loss because you are depreciating it. So whether you can take the full benefit differs and varies among person to person, but whether you can take any benefit is usually a 100% yes, you can, because what we want to do is make sure that you're showing as little profit as possible, and that comes through the use of depreciation. So number one thing that you should be aware of when it comes to syndications is depreciation. And when I say you should be, again, I really mean the people that are operating the thing, the accountants that they're working with should be aware of depreciation. Number two is capital gains on the sale. So one thing that people often look for when it comes to real estate or syndications is the perceived lower tax rates that you get by investing in capital assets, right? You may be familiar that capital gains are taxed at different tax rates than ordinary income. The highest tax bracket right here in 2024 is 37% on an individual level. The highest tax bracket on the capital gains level is 20%. So that's a difference of 17% if you're at that highest bracket on both. And so capital gains rates are beneficial to people that are looking at real estate, whether it's property for your individual single family, a duplex, a quadplex, or you're looking to go in with other people and form a syndication. You are still going to get the benefit of the capital gains rates as opposed to the ordinary income rates. And this is important for, again, your accountant to know that capital assets are taxed at capital gains rates and not ordinary income rates. Unless, of course, the capital asset is held for less than 12 months, right? Short-term capital gains are taxed at ordinary income. So this is something that you're going to want to make sure that if you're investing in a syndication, the people are intending to hold it for a longer time period than 1 year. And often that is the case, right? And so one thing that often benefits people that are involved in syndications is those lower capital gains rates. So you made $1 million on a sale of a property, that $1 million is not being taxed at the 37% rate, but it's being taxed at the 15 or 20% rate. That's a difference of $170 or even call it $220,000 in taxes that you get by taxing it at the capital gains rate over the ordinary income rate. Okay, so that's topic number two. We have depreciation, we have capital gains rates. Another form of the capital gain benefit that comes with investing in real estate is 1031 exchanges. Now, this is probably not new to a lot of the listeners. 1031 exchanges are one of the most attractive things about real estate, and that's been the case for time after time, right? There are people that have been 1031 exchanging since they started, which I don't know exactly when that was, but if you've read any of the books by Robert Kiyosaki, if you listen to Donald Trump, or some of these other real estate people, real estate professionals, real estate influencers, you know that 1031 exchanges are one of the benefits that come with real estate. And it basically says you can exchange a capital asset for another capital asset of equal or greater value, and we will defer that gain over time. So in the event that you have $1 million of capital gains, we can look to larger real estate asset to defer that capital gain to the next time you sell a property. And what benefit does this have to the syndicator? Well, say you invest in a property that has that $1 million capital gains. You will get a form of that capital gain passed down to your personal tax return. Now, say the people that are in charge of the syndication decide to do a 1031 exchange. And now, instead of a $1 million gain, you have a new property that is of greater value, likely getting greater cash flow, possibly getting greater depreciation tax benefit, and you don't pay any capital gains rates at the time of that transaction. It is deferred until you stop doing the 1031 exchange. And 1031 exchanges can be done until you die. That's the old adage, 1031 exchange, and then you die. And then there's a step up in basis for whoever takes care of the properties. 1031 exchanges are available to you on the single family level and as great as the syndication level that can vary in number of units and number of investors. So we have depreciation, we have capital gains rates, we have 1031 exchanges, we have passive activity losses. Okay, I talked about this a little bit about in the depreciation strategy. People often ask, how do I make use of depreciation when I am in a syndication? People often ask this at a individual investor level, right? They're like, how do I make use of depreciation on my duplex, on my quadplex, on my single family? And the question remains the same. How do I make use of the depreciation? How do I get the maximum benefit from a depreciable asset? And it varies. Again, going back to that famous saying, it depends, right? If you are full-time real estate, the benefit you get from losses on real estate is not going to be the same as the benefit that somebody who is full-time W-2 making $250,000 or more a year, right? It varies from person to person. No situation is the same. I don't care what the Instagram influencer says. I don't care what the TikTok influencer says. I don't care what the enrolled agent or tax professional on YouTube says, aside from myself. No, but seriously, the idea is that your situation is going to vary from your neighbor's situation, from your cousin's situation, from your uncle's situation. Everybody's situation is different. But the one thing that is the same is that passive activity losses apply to everyone. And they say that if you don't materially participate in an activity, then it is passive by nature. Real estate went one step further and says real estate is passive unless you participate in it materially and meet the real estate professional or the material participation requirements, which vary. There's about 7 steps, but at the maximum level, the real estate professional is 750 hours and more than any other time that you have in money-making opportunities. To summarize them as best as I can, obviously the verbiage is a little different in the tax code, but the idea is that real estate is a passive activity. So if you're in a syndication and they're making use of depreciation and you're getting losses passed down to you, it doesn't change the fact that you are getting passive activity losses. Passive activity losses can be offset by passive activity income, but they cannot be used to offset ordinary income in the form of a W-2 paycheck or business income, right? So there is a benefit to a passive activity loss in that it can be used to offset passive income, but there's a drawback in the form of that it can't be used to offset the W-2 income that you're using. So one of the questions we got from a friend or from somebody in our course, his name's Alex, he asked, how can I make use of syndications and the tax benefits as a high income W-2 earner? And the answer would be, unfortunately, chances are you won't be able to take the full benefit because you're looking to offset active income with passive losses, and that doesn't mesh well. It will lose in an audit. You will owe taxes, penalties, and interest. So, but that's not to say that you can't get any benefit, right? A proactive real estate tax planner will be working with you to carve out or to think about new ways that we can create passive income or make use of these passive activity losses. And that's what you should be doing as a W-2 wage earner interested in real estate. So we covered depreciation, we covered capital gains rates, we covered 1031 exchanges, we covered passive activity losses. The fifth and final benefit or thing you should be aware of when it comes to investing in syndications is cost segregation. Everybody loves to talk about cost segregation. They hear that it is this great new loophole that is available to every real estate investor, and it is. We love cost segregation. It's great. The IRS even loves cost segregation. They advise you to do it. However, you want to make sure you're doing it correctly. You want to make sure that if you're investing thousands of dollars in these engineered studies, that you can actually get the benefit. And syndications can make use of these cost segregation by passing on the depreciation and the passive loss that it usually creates to the investors. However, again, we go back to the passive activity loss rules, and we have to make sure that you can fully benefit. Now, don't think that you get a passive activity loss and if you can't use it in that year, it just goes away. No, those things get carried forward, and a good tax planner will see that you have passive losses carried forward and come to you with strategies that you can make use of to create tax-free income as a result. We've done this with a few of our clients. One is a high income earner making about $400,000 in a W-2. Another just had about $50,000 of passive losses carried forward, and we unlocked it all through the power of tax strategy. So make sure that you're meeting with a real estate tax professional and considering, what can I do to get on top of my tax bill? It requires diligence. It requires you teaming up with the right person And that comes through research and finding the right people, doing your due diligence out there on people. We have a variety of testimonies of people that we've helped do things just like this. We specialize in real estate tax. We've done hours of continuing education to make sure that we're at the top of our game in terms of tax planning and real estate tax strategy. And if you're looking for someone new, we are taking on new clients. We don't work with everyone, so you can find out if we are a good fit for you. But the 5 things that you should be aware of when investing in real estate syndications as far as taxes go: depreciation, capital gains rates, 1031 exchange, passive activity losses, and cost segregation. You can get a benefit from all 5 of those things, but you need to be working with the right team. Now, things that you should be aware of, things that you should be warned about when it comes to investing in syndication. One goes back to the passive activity losses, right? People will tell you that you get a tax benefit, but if you're not working with a tax strategist or a tax planner who is going to make sure that you get the benefit, you are going to be sold a bag of goods and have a lot of unused tax benefits as a result. So be aware that you might not get the full tax benefit by just putting money in a syndication. It requires planning. It requires meticulous research and understanding of the tax code, what's allowed, what's not allowed, okay? Investing in retirement funds, right? A lot of people these days are using self-directed IRAs to invest in real estate. Those cap the amount of benefit that you can have, right? If you do a 1031 exchange and avoid capital gains taxes on a property that you had in your retirement account, well, guess what? You weren't going to be sold. You weren't going to be taxed on the capital gains in your retirement account, right? Those are usually tax-free on growth or tax deferred until you withdraw. So if you're holding a property in a retirement account and then you go and sell that property and you keep the funds in your retirement account, you won't pay capital gains rates. So don't be sold a 1031 exchange on a property that is in a retirement account that can't take the full benefit of a 1031 exchange. We talked about the passive income versus loss rules. That's the biggest thing. We see people going in on syndications thinking that they're going to get a tax benefit. And I believe this is probably why the question comes up so much, is because they thought they were getting something. They didn't end up getting the full benefit, and it cost them in the form of frustration, anger, or maybe returns, right? Could they have done something more with that money outside of real estate? And then limitation for high income earners, right? The question was, what can high income earners do to make use of syndication? There are differences between how much of a passive activity loss you can write off depending on how much money you make. And if you make over 100,000, or especially if you make over 150,000, you get phased out of the amount of passive activity loss that you can write off and offset with that ordinary income. So there are some possibilities for you to offset ordinary income with passive activity losses, but they do require you to make less than a certain amount of money. It is less than 100,000. You can write off up to 25,000, and then that 25,000 gets phased out by 50 cents for every dollar you make over $100,000. So know that there's a limitation on the amount of passive activity losses that you can write off as a high income earner. Understand that syndications often come with minimum investment requirements. So we've seen them as low as 25,000. Some have as high as 100 or 200,000. They vary from project to project. We actually had Julie Roy on the podcast. She talked about some of the deals that she does. She has minimum requirements, and I think even Grant Cardone has some that are for the lower level investor and just want a stake in something that could provide them with a cash flow. So understand that there's usually some minimum investment requirements, but you can usually find them, like I said, as low as 25,000, and then they go up from there. The other thing I'll say is vet the investors, vet the investments, vet the track records. As with anything, right? If you're working with a professional, you're going to want to make sure that you do your due diligence on the professional. You're going to want to make sure that you do the due diligence on the project. Make sure that the numbers are adding up to what they say they can be. And this is just to protect you, because obviously a tax benefit is only as good as the investment itself. If you're investing in a property that doesn't cash flow or is going to go under in 3 years, then yeah, you might get some tax benefit, but you're going to wish that you had the money back anyways. So just some overarching things that you're going to want to be aware of as you consider syndications, but we did kind of cap off the tax ideas, tax benefits, tax drawbacks here on syndications, and I trust that this was valuable for you all. If you are dealing with syndications and you're not sure that your tax professional can handle them or is going to make the best use of them, reach out to a qualified tax professional, somebody who's a tax planner. We've done a couple episodes on the difference between tax planners, tax preparers, difference between tax planning and projecting, and you really want to make sure that you're teaming up with somebody who is a specialist. And so if you are looking for a real estate specialist, we are taking on new clients continually. We do cap the number of people that we work with every month. And so if you think, you'd be interested to see if our services are a good fit or we mesh well, we'd be happy to throw your name in the hat and see how it turns out. That is all here at the Know Your Numbers REI podcast. If you got any sort of value, go ahead and leave us a 5-star rating and review. If you know somebody who's in syndications and could use this as some important insights as we head into tax season, go ahead and share it with them. We love to meet new listeners, hear how it is treating you. And if you have questions about taxes, go check out our Facebook group, Tax and Accounting for Real Estate Investors. We're posting in there daily, and we are asking you to share your questions. So if you have questions that you'd like us to address here or in the group, that is available to you. Until next time, God bless you all and keep moving forward.